Governor, great to see you. Thanks for doing this.
Great to be here.
There are two sort of competing narratives about the economy right now. One expressed itself quite thoroughly through the markets this week. You say it's a double-sided risk. Give me the case for the upside. What is the positive view of where the economy is and where it's headed?
So markets are quite preoccupied with good reason, with the threats of trade actions and how that's going to slow down China and also, by the way, the United States and other places. And all those indicators that are coming out and rolling over, that's a global thing. IMF has rolled back its forecast. We all have. So that's important and it's real. And the threats are for something bigger. That's the big worry. But what is the plus side? The plus side is, well, that's all just kind of a way of negotiating, and suddenly, the minds get together and it evaporates. So I said this 3 months ago. People were completely preoccupied about NAFTA's going to get torn up. And I said, well, hang on, what if it doesn't? We have to compare both sides of this and try to strike a risk-balanced approach in the middle.
But when we look at the economy today, is it the job growth and some concerns about that wages haven't been keeping up? Like, what are the positive indicators that make you say we can sustain this and we can, in fact, sustain a few more to get back to neutral?
Well, we have everything firing. This year, both investment and exports have been quite good contributors to GDP, despite the angst around the future of NAFTA. And so that suggests that it can only become a little stronger with that angst removed. Are there problems in the world? Well, yes, but there's always, as I said, risks up and down. So for now, we have to confront the data that we actually see. The household sector has remained strong. We raised interest rates, noticeably in the last year, and everybody's absorbed that well, and so we're cruising along there. And the labor market remains strong, and yes, wages haven't been that strong, but they're still well above 2%. And so at least we've got that growth. We expect the next phase of the cycle to be higher productivity and higher wage growth.
The households have managed these rate increases. The concern, though, is as that debt service ratio grows, as people sort of have taken on an awful lot of debt, is there a point that you're concerned at that maybe if we go to X percentage, or like what is it that would push us from having concerns about debt to having a debt crisis on our hands?
Well, there's no magic number. That's important. You can slice the Canadian society in many different ways. They're highly indebted people that took out a mortgage 3 years ago. They have 2 years to go. Others to go last year. They have 4 years to go, et cetera. Very complicated question. So as we see it, as we move interest rates up, and each time watch how that reacts. How does credit growth slow down? How much? What happens to the housing markets? And I ask people to bear in mind that if we hadn't started normalizing things with interest rates and with better rules around mortgage lending, well, wouldn't house prices have continued to skyrocket, and wouldn't affordability been a even bigger problem today? Interest rates are a small part of that affordability issue compared to house prices themselves. So let's not forget what it could have been like without this.
The 2008 crisis was essentially a debt crisis. We dropped interest rates to encourage consumer spending. Yeah. Is the concern that we created a second crisis to get us out of the first, and that right now what we're doing is trying to navigate a pretty sharp line?
Well, there's no question. We had a crisis. It was global. All the central banks and all the fiscal authorities acted together and prevented, I would say, the second Great Depression. So let's put up a victory sign for that.
Right.
Okay? It could have been way worse. But one of the side effects of that has been this accumulation of debt, whether it was the government doing it, okay, through fiscal action, or in our case, the central bank did more, let's say, over those years, say 2010 to 2013, 14 in there. Well, during that period, it was low interest rates doing most of the work. And that means the debt is being accumulated by households instead of by government. But either way, you've got debt. And
right.
We've got a debt overhang from this. And it's going to take, yes, a substantial length of time for us to work that down.
And in theory, as an economy does better and we raise the rates and people try to manage their way out of that debt, wages go up and offset some of their ability to pay that down. Is that where wages become more of a concern, that we haven't seen the uptick in wages as we would expect to see with this amount of unemployment?
Well, wages are a piece of the puzzle, but there's a lot of other pieces. And the most important part of this is at this stage of the cycle, and I would say over the past 18 months, we've been in that stage of the cycle. Normally, investment would have been the key driver of growth, and that would be adding to our productivity and our ability to increase our capacity and our exports.
Right.
A virtuous circle. And that cycle kind of got stopped by the uncertainty around NAFTA. And we are hoping that it now resumes. In fact, that's what's in our forecast, modestly so. And when that productivity comes, then you take the lid off of those wage settlements. Okay, you allow the extra percentage point or so, which typically around here we'd be expecting 3 to 3.5% wage growth, not 2 point something.
Right.
And I'm quite confident it's going to happen. There's a lot of signs that the productivity move is happening.
Where do you see us in the cycle? If we go back to sort of March of 2009 and the bottom in the markets anyways, to where we are now, we're certainly nearer to the end than the beginning, but where do you envision us on that line?
Well, we're in the mature stage of the cycle because we've pretty well reached home. We're at the stage where, the economy is operating where it can. There's some, questions around it, but it's where it should be. And the question is, how much longer can it go? And the answer is, for a really long time, if nothing happens to mess it up.
Right.
And historically, almost all of the slowdowns have been caused by central banks, frankly, because inflation pressures begin to emerge and they raise interest rates a bit faster than were previously intended. That slows it down. But that's all about the thing about keeping inflation on track. If we're able to anticipate well and if things continue to expand as they are, there's no time limit on how this can go.
Do you wish, looking back, that you could have had even just one more rate hike under your belt by this point? Or do you think you're comfortable with where we are?
No, haven't been surprised yet by this. The debt made us wary from the beginning that every interest rate move was going to count bigger than it has in the past. And we did some more research and we expanded that in our model. So our model now has 50% more interest sensitivity in it than historically. So we're taking that on board and monitoring how we're doing. And over the last 12 months, the model has done a good job of predicting how people would react. So our confidence is growing that we've got that about right.
When the word gradual came out, you knew people were going to immediately say that means the bank is more hawkish. Are you okay with that interpretation?
Well, I have to be because the markets are never wrong, Peter. You and I both know that. But the fact is we are not trying to give a hawkish signal, but what we're trying to do is make people understand that the pace of getting to neutral is the thing we've described as gradual. First it was cautious, then it was gradual, which people say, that's faster. And now as your confidence grows, you say, well, now we need to be talking about what it is that will determine that pace. Much more clearly laid out now, so we've got a big definition of what used to be called gradual now in our press release. And I'm hoping that's clarity not just for market, but also for individuals who need to plan ahead.
I've spoken to you at several stages through this recovery. You seem more confident, more at ease with the situation that we're facing. Is it easier to be a central bank governor at a time like this, when there's still a lot of unknowns, than there was when you couldn't figure out why we weren't getting the traction that we wanted?
It's way easier when the economy appears to be behaving more as you expected. When we were searching for missing exports or trying to find out why people weren't investing, or oil prices were collapsing, or always something moving that's unexpected, that's a much more difficult situation. Here we're in a more traditional space where central bankers have to be guarding against inflation risk and yet giving the economy every chance it can to expand in a non-inflationary manner. And that is a more comfortable place to be, yes.
Well, it looks good on you. Thanks for doing this. Really appreciate making the time.
Pleasure.